My question is that you have a P&I loan and you have an interest-only loan, and usually when you go after these multifamilies, you try to get a few years of interest only.
Mm-hmm.
But by listening and watching what you're doing, it seems like it would make more sense for me to continue with a P&I loan and to make the payment schedule like you're talking about. It would actually save me instead of getting an interest-only loan.
Well, guess what? Guess what loan I love the most? An interest-only loan. Because once you have
All
an
right.
interest-only loan, there's a couple of things that happen just based on what we just went over a few minutes ago. Because when you have an interest-only loan, you are in complete control of the principal payment. See, the more control you have over the principal payment, the more damage you can do to this loan and the more benefit you can bring to yourself. Because number one, if you have an interest-only loan, then your interest payment is based on the principal balance, correct?
Correct.
So if you were to put some money on principal, you would lower the principal balance. Then conversely, what would have to happen to your interest-only payment?
It'd be canceled?
No, I'm saying, would your interest-only payment stay the same? Or would...
No, it would actually go down because you're paying the principal down.
Yes, it would. And you're in complete control of when you do that. You see, right now, your principal payment, if this was a principal only loan, the one I have on the screen, because I've got that number right here. I've got that number here. So the principal only payment is $1,020.83. Now I can continue to make that, okay? But a year from now, I would have paid 12 times 120. So let me bring my little calculator up. We're putting that on the screen. Okay, so it'll be 12 times $1,020.83. Boom. All right, come on, 83. You got it. Okay, that's $12,249.96. So if I were just to make the interest-only payment, I would pay that. But there is a strategy of using interest-only payments if you're a real estate investor. As an example, now a lot of real estate investors I know have some money on the sideline, just to do maintenance and repairs. Would you happen to be one of those investors that keeps some cash on the side for repairs and maintenance?
Correct.
Okay, let's just say, I don't know how much you have, and you don't have to tell me, but let's just say that money is sitting in a bank and it's making about 1/10 of 1%. And you have this same loan I have on the screen where $6,700 would be paid down in 1 year. Okay? So what if we decided out of that reserve fund that's making 1/10 of 1%, you could take $6,700, apply it to this loan, knock off 12 regular payments that you would normally make, and be paid down to line 12 on your amortization schedule, where you would owe not $350,000, but $343,283.01. Now you have $6,700 in equity, and your next mortgage payment is actually less because it's based on what? The principal balance.
The interest. Yeah.
Yeah. So I'm telling you, when you are in control, this is why it's important when you're setting up these loans, even a P&I loan, you want to set it up so that you have more control over the principal payment. You want to control that so that it benefits you more. Now, let me show you something here. All right. So I have a 3.5% loan. All right. Now, I know a lot of real estate investors, it's nothing for them to see a 5% in this category. Let me show you something. I'm going to duplicate this tab and I'm going to change this to 5%. Okay. Everybody I know is trying to get the best interest rate possible, which to them means the lowest interest rate possible. But we're going to delete that. I keep hitting the wrong button. Sorry. I'm trying to talk and do this all at the same time. Hold on for just a second. Okay. Now, here we go. It's 5% now. Okay. The same amount of money at 5%. And I want to show you what happens at 5% as opposed to 3.5%. Because when we're attacking the loan, we're attacking with principal payment. The principal payment on this loan now at 5% is $420 starting out. At 3.5%, it's at $550 starting out. Okay. So remember, it took $700 to knock out 12 months worth of payments at 3.5%. Let's go to the 5% loan and see what the same $6,700 would do for us. Oh, $6,700 knocks off about 15 payments, just a little less than the same amount of money between line 16 and line 17 by having a higher interest rate instead of a lower one. In fact, hopefully I can talk about this where I had a client actually that's closing on the 15th of the month, went back to their lender and said, you know that $2,500 you offered us to get the higher interest rate, but we opted for the lower one? We actually saw some videos online, and it would be better for us to take the higher interest rate and you give us the $2,500, because now we can actually pay the loan off faster and cheaper at a slightly higher interest rate.
But Don has some valuable information that can contribute to the quality of a person's life. And it only costs you a few dollars. It's his book. Why not get that?
I'm going to go through the P.I.L.L method myself with some of my investment properties. So I'm going to link up with Don, and then I'm going to sit down with him, show him my investment portfolio, and see how I can eliminate interest.